Hello and welcome to episode 17 of the Talking Central Banks podcast with me, Karan Marishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about Turkey's monetary policy challenges amidst galloping inflation, consumption slowdown, and macro volatility. Our guest today is one of Turkey's most celebrated economists, Şevin Ekinci. Most recently, Şevin served as the chief economist at Fonksiyonel Holdings, one of the largest conglomerates in Turkey. She started a career as an economist with WestDeutcsche Landesbank or WestLB in 2002, where she ultimately rose to become a senior economist. She then moved to Dexia as a senior economist in 2007. In 2011, Şevin joined Trusted Sources, now TS Lombard, as a senior analyst and economist, covering Turkey and the Middle East until 2013, and again between 2018 and 23. Previously, Şevin was trained at Merrill Lynch, San Diego office. She holds an M.A. in economics and finance from the Bosphorus University, an M.B.A. from the University of California, San Diego's Radi School of Management, and a B.S. in economics from the Middle East Technical University. Welcome to the show, Şevin.
Yes, welcome. Thank you very much.
You're very welcome. So, Şevin, I wrote an article on the so-called monetary experiment of the Turkish Central Bank back in 22 for Nikkei Asia. And in that article, I argued that the unconventional monetary strategy adopted was rather successful at the time. In this context, Şevin, December 2019 is a pivotal time frame in Turkish monetary policy history. And not only because interest rates were reduced by almost 6%, but also because after that, Turkish economy managed to lower its unemployment figure to 10%, recovered most of its forex losses by increasing its reserves from $84 billion in September 2018 to $101 billion in July 22, while successfully maintaining capacity utilization levels at around 80%. As I mentioned, this monetary experiment was in complete opposition to conventional monetary policy wisdom and perhaps played with the right-hand side of the quantity theory of money equation, where a higher money supply will be equalized by a higher output with high inflation acting as a multiplier, only discounted by a very low velocity of money, thereby resulting in economic expansion, as we saw in Turkey at that time. Keen to know your thoughts and critical assessment of this experiment, Şevin.
Well, okay. Well, actually, I wouldn't call 2019 as a pivotal year. It's actually started with 2017, but maybe we saw the pivot in 2019 because, Murat Çetinkaya, right before the change in the governor in 2019, he tried to keep the interest rates quite high, but our president Recep Tayyip Erdogan was a keen political name. He's the president of the country, of course. He's keen of low interest rates, so he was pushing, sometimes interfering, to central bank policy towards towards lowering interest rates. And Murat Çetinkaya did not left his office. Murat Uysal started his term as a CB governor in mid 2019 with this type of pressure from the president for lowering interest rates. So he had no choice but decreasing interest rates. Yes, maybe you can think that there was an increase in the output at that time, but I will give the details of this growth rate in my coming sentences. But let's see this Turkish experiment between December 2019, I should say, and 2022, or let's say July 2019 and December 22. They have tried to tolerate high inflation at that time, and let's do not forget that COVID hit the global environment, global economy at that time as well. I think Turkish economy has benefited from this impact, from unexpected COVID crisis, and Turkey economy entered with low interest rate policy to COVID pandemic. Right. So this period was marked with credit growth, pandemic period of global liquidity, strong exports, I will call, because the low interest rates has benefited the exporters with weak local currency, as well as there was a rebound in tourism in 2000. Let's do not forget, there was a rebound in tourism in 2019 before the COVID, and after COVID as well. So reserves, yet you may call them it has increased, but not in net term. The gross reserves increased at that time because there was a heavy use of swap transactions with United Arab Emirates, with China, with Qatar at that time. Also, there was a backdoor FX sales from the state banks. So reserve accumulation was not organic, like trade surplus or foreign capital inflow, but basically through some swap transactions and FX sales of the state banks. You may call that there's also the capacity utilization of 80%. Okay, maybe we can see it. Okay, but it happened at high inflation times in Turkey, and as I said, there was also a huge export demand, and the exports benefited from the depreciation of the local currency at that time with low interest rates. So weak currency, of course, benefited the exporters. But on the other side, I will not be a supporter of this policy, because the inflation eventually has lowered the real income of the public, right? It reduces the real income. Inflation reduced the real income. On the other side, there was a capital flight, capital outflow, because of the negative real interest rates. Not only the nominal interest rates were low, but the real interest rates were at negative level, and there was a capital outflow eventually. And there was an FX depreciation more than the inflation. So I believe that the current reason of an uncontrollable inflation in 2022 was this policy, this irrational policy. Maybe we saw an increase in the growth rate, but what if we didn't have COVID pandemic at that time? I believe that the COVID pandemic, just as a coincidence, helped this policy, but it was irrational. I remember at that time, Fed had entered to the COVID pandemic with a high interest rate, but right. Whereas Turkey entered to the period with lowering interest rates. However, let's remember also the Central Bank of Turkey had to increase the interest rates before most of the global banks within the COVID period. I remember like in October or November 2020, the other governor increased the interest rate, and he has been sacked because of his high interest rate policy. After 4 months, he has been taken from the office. Through the end of the 2020, he hiked the interest rate, and it was a risky decision during the pandemic, but they had to, because the inflation started to increase. So let's do not forget that Turkey entered, like by coincidence, with a low interest rate, COVID period. Yes, it benefited, but there was not an organic increase in output or in reserves. In short run, rest maybe yes, it has benefited, but in the long run, you see the skyrocketed, ultra high inflation came from this policy, I think, and I'm not in favor of it at all.
By the way, Shevin, what do you think about the Q3 GDP numbers? I think they were out yesterday. Will this have any material impact on the TCMB's rate decisions from now?
You mean CBRT? You see TCMB? Okay, TCMB is Turkish.
Yeah, the Turkish central bank.
It's a Turkish central bank, yeah. But I think we can say CBRT is Central Bank of Turkey, Republic of Turkey. Well, it was within expectations, Karan, because we were expecting a GDP number like around 4%, which is quite okay for the time being, because the potential growth number in Turkey is around 4%, but it became lower than that, lower than expectations. Yes, the private consumption increase is still lower than the previous high levels, and also the export performance is still very low. There was only a boost from the construction sector there. Yes, the real sector is increasing because of the construction, but there is this deficiency in the agriculture sector. And for sure, they should do something for the agricultural sector in Turkey. And it's quite obvious from the figures.
Speaking of which, Shevin, Turkey's annual inflation rate is currently 33%, around 33%, which was above 70% last year. Can you please explain why the inflation rate is galloping in Turkey as compared to the inflation rate among peers?
Among peers, yeah, of course, it's one of the highest right now, right?
Yeah.
But this is also because of the previous irrational policies. Currently, we cannot say that the inflation figure in Turkey is galloping. Because since mid-2023, there is now a very credible economic team in Turkey with Mehmet Şimşek and Fatih Karahan, thereafter after Hafize Gaye Erkan. The central bank governor is quite credible, talented, and as well as the finance minister, Mehmet Şimşek. I wouldn't call galloping inflation right now, but it galloped up until the 2023. But we have to consider, yes, we can say from 2017 to 2023, yes, the inflation rate galloped. And the reason is very simple, right? We started with your first question about it. There was an irrational, I think there was many economic missteps with irrational monetary policies. Anyone who has studied economics would expect this high inflation at the end of the 2022. With ultra low interest rates, we would have ultra high inflation. There's also this political instability problem in Turkey. Political problem creating also expansionary fiscal policies. Expansionary fiscal policies created the high inflation. Let's do not forget that the election cycles are not very regular in Turkey. For example, the latest one when we had very good inflation figures. Since then, it has started to deteriorate. Before the 2016, we had double elections in right before the 2016 in a year. They didn't accept the results. They opened another election again for 6 months. And we do not have a regular cycle of elections. So it caused expansionary fiscal policies, which had fed the inflation. The economic missteps, low interest rate policies, which had fed the inflation. Also the COVID period, I would call. In the COVID, they couldn't respond very quickly to the increase in inflation because there was a problem of growth at that time, and they had to continue this low interest rate policy for a more while at that time. And there was this stubborn approach to ultra low interest rate. Let's do not forget, many times they have changed the central bank governor because of their inclination towards hiking the interest rates. So this stubborn, irrational economic policies also caused the inflation. But I do not mention about the recent policies. I mention about the period between 2017 and 2022, the end of 2022. So, and also there's a high exchange rate pass-through in Turkish inflation. What it means? The exchange rate, the weak local currency, has high impact on the inflation. It's one of the main determinants of inflation in Turkey, the exchange rate, depreciation in the exchange rate, because Turkey is highly dependent on imported intermediary goods. Right. Most of the final goods made by the imported intermediary goods, maybe 80%. So as soon as we have an increase in the cost of the intermediary goods, which are important, they have to reflect it in final goods, right? There's a cost push effect. There's cost push inflation. Right. Also, this loss of confidence, I would call loss of confidence of the foreign investors after 2016. Some, maybe, I will mention about the loss of confidence maybe later on. And of course, the loss of interest of the foreign investors to this loss of confidence. Also, currently, the inflation comes mainly from the services sector. The growth profile in Turkey changed a lot in the last couple of years. You will see in the global growth as well, because the services sector started to surpass the industrial sector. It's growing much rapidly than the industrial sector, like hotels, like restaurants, like housing costs. These are all services costs, like the transportation costs. The main reason of the inflation in Turkey for the last couple of years is because of the increase in the services sector. The government has tried to contain the inflation in the rent prices, housing rent prices, by putting a ceiling like 25% previously. They have used it for a while, but you can imagine once you pull off this strategy, once you leave this strategy, the hike in the housing rent prices is higher compared to the previous time. So there is also this I would call unnatural effect on the housing rent prices as well for the time being. So it will take a while for the housing rent prices to stabilize and to be consistent to help to lower this inflation system in Turkey. Plus, this is this thing that the Central Bank of Turkey currently mentions. There is this pricing behavior in Turkey. We learned that the academic studies show that there is two reasons for the increases in the inflation. One is time dependent and the other one is state dependent. When it is state dependent, it depends on the demand and the supply mechanism. The prices affect from the demand and supply factors. But when it is time dependent, like educational prices, like health prices, like rent prices, house rent prices, they have to make a routine increases in these prices, and one-off increase in these prices make a big effect on the year-on-year inflation. For example, in January we had this 5 or 6% monthly inflation, but not on the other months. So these routine increases in prices did not fade off yet. There is this time dependency still on some of the prices in Turkey, especially in educational prices. The university education prices are very, very high here. So this is a reason. And one another reason, maybe I can say final right now, is the income distribution, deterioration in the income distribution in Turkey. It's very high. The top 20% rank income level in Turkey and the lowest rank, there's a big discrepancy between them. And wage earners, salary earners do not spend as much as the top 20 or 10%. The main reason of this consumption is coming from the top 10 or 20%. The main reason of this inflation is coming, I believe, coming from the top-ranked income distribution percentile, I will call. So, yeah.
You're suggesting, Şevin, that over the years, inequality in Turkey has risen, and that has impacted consumption, even though we'll talk about consumption later on, but just to add this point.
Definitely. Yeah, I believe in that. Yeah. You said 70%. We saw even 85.55% within some months of 2022. Now it's 33. So we cannot call it galloping right now. It's about to decline, thankfully, which I'm very glad with. Yeah. In the new economic team, after the appointment of the new economic team, it's at least controllable right now. But these are the effects that caused the high inflation.
Yeah, the lingering effects generally take time to sort of normalize. But trying to make sense of the impact of the global scenario on Turkey macros, and you did mention, Şevin, about the impact of this on inflation. Under global protectionism in trade, geopolitical rivalries, and uncertainties, where do you see the inflation rate evolve over the next couple of years, given that the Turkish Central Bank's target range is 13 to 19% in 2026?
Yeah, when it comes to the central bank targets, it usually misses its targets. I will say since like 2017, the Central Bank of Turkey missed its targets. But this target range is important, 13 to 19. And I think we should take into consideration this 16%, which is the mid target. The Central Bank of Turkey this year has started to give a intervally. They started to give their target. Actually, the main inflation target in Turkey, when we call targets, not expectation, 13 to 19 is an expectation, is an official expectation.
Right.
But as we are looking for what is the target is 5%. The target was 5% for a long time. But we all know that 5% inflation target is unachievable right now. So for this, they brought this year a mid-targets per year to achieve this 5% target. So, for example, the target for next year is 16. The target for this year was 24. We are already above it, but they will have to give the reasons why they did not achieve this target. They have to give the reasons at the end of the year to the markets. We have to hear the Central Bank of Turkey. They will not only give the reasons to the government, but also to the public as well. So it's good for its credibility, and it increased its credibility. The 16%, we have to take it as a benchmark target. But I think we have to take it as something. I think the government, the Central Bank of Turkey, make it to affect the inflation expectations, because the expectations are still very high in Turkey. So with the official expectations, with the official target, maybe they are trying to affect the public expectations or the financial market players' expectations. Also, to create some consciousness within the public. Also, maybe to increase their credibility. They gave this target, but they know that they cannot hit this mid-target, 16%. I personally expect, if everything goes well, in economics, we have this saying, what was it? It was not sine qua non. It's a Latin verb. Everything is constant. Taking everything is constant. I do not recall it right now. There's a Latin saying.
I get the. I understand the point.
Giving everything is constant. I would expect the inflation rate in Turkey next year in good conditions, like in 23%. 23%, which is okay, which is understandable. I joined the International Rating Agency meeting last week, in 2 weeks ago, I think, and the Standard & Poor's, the International Rating Agency Standard & Poor's, they expect 20% inflation in Turkey, which is good. That means they are hopeful about the economy here. My expectation is 23%, but you should always have in your mind that there is this political risk always in Turkey. The easing policy of the United States Central Bank, Fed decision, would help next year, because at the end it will lower the value of the dollar index, and it is good for the it's against the odds of the depreciation of the local currency here in Turkey. So there's this wind behind of Turkish economy and Turkish Central Bank from this global central bank policies like Fed. They will ease their monetary policy, and it will help. But global protectionism, yes, it may increase the imports prices of Turkey as well as the imports of United States. Well, if there's no political crisis in Turkey, I would expect 23%. Let's be optimistic a little bit.
Just curious to know, Shevin, why are household loans growing significantly in the country as compared to the traditional corporate and private sector loans? How do you assess this trend at this time?
I do agree with that. The growth rate of the housing loans is higher than the corporate sector loans for the time. But if you look at the actual figures show that the corporate loans are higher than the housing loans. If you compare the growth rate, yes, the housing loans, there are, of course, many reasons of it. First of all, let's look at from the corporate side, because corporate sector loans, corporate sector position is not good for the time being in Turkey. There are many challenges for the corporate sector right now, and we heard many failures in the corporate sector, bankruptcies in the corporate sector. They do not only, it's not only because the interest rates, but also because of the economic uncertainty. They do not incline to take these bank loans because previously they had this experience and they have failed. We did not see this failure yet in the housing sector loans, but we saw bankruptcies and non-performing loans in the corporate sector previously. So they approach to bank loans quite cautiously for the time being. This is, if you look at it from the corporate sector side, I am sure there is this less interest from the corporate sector for the time. Also, the interest rates in the markets right now, also, despite Central Bank of Turkey has started to lower the interest rates, the housing loan rates is lower than the corporate loan rates right now, or the personal private needs loans rates right now. For example, in corporate loans, the interest rates, annual interest rates, is between 53% to 70% for some banks. But for some for housing loans, we see 38%. Around 38% levels for the annual interest rates for housing loans. It's lower. It's one of the lowest. Personal private need loans is around 45%. This might be another reason. The reason of this also is because the bank sees the housing loans, at least for the time being, less risky than the corporate loans. They see the housing loans less risky. It's because they have to deal with the personal loans. Also, there is this reason. It's a cultural reason. The real estate investment is culturally, it's a safe investment in Turkey. Turkish people, the residents of Turkey, prefer to have investment as real estate. It's a cultural tendency in Turkey. The most safe investment for them is housing. Believe me, when you talk to someone, where do you want to invest your money? If they have an investment, they always look at the real estate sector. This is also another reason. Also, there was this government programs, subsidizing influencing the public for having houses. The government also has boosted this ownership, government programs as well. And safe investment structure in, they see this housing sector quite safe. yeah, the financial institutions favors this type of loans. Also, let's not forget the house prices also decreased in the last couple of years. This year and last year, the housing prices. There's somebody's calling me anyway. No problem. The housing prices declined in the last couple of weeks. It will start to increase next year. This is also one of the reasons. But there's this risk of default, of course. Now, from the corporate sector side, there are challenges, Karan, like bank lending policies, foreign currency volatility, the still high interest rates, and economic uncertainty right before the elections. The corporate sector approached this bank lending more cautiously than the housing investors, I would call.
Okay.
Yeah.
So any idea about the loan to value ratios in Turkey, Şevin? I mean, generally what happens is that when the loan to value ratio increases, then that has an impact on consumer household loans. So is that the case that you see, or is there some other?
I don't think that's the only reason of it. I think the reason is the loan to value ratio. It will also impact the demand for the housing loans for the housing sector.
Right.
Yeah.
Right. Despite this demand for real estate that you mentioned, Şevin, private consumption has been growing at just 3.3% in 2025, which is rather low since Turkish economy has been traditionally driven by a strong domestic consumption. Do you think that the higher inflation rate has been impairing consumer demand in the country as we speak?
Sorry, can you say the last sentence again?
I was saying that, do you think that the higher inflation rate has been impairing consumer demand in Turkey?
Oh, okay. Yeah.
At this time?
I think we have to look from the flip side of the coin as well. Does the inflation lower the domestic demand, or the higher private consumption cause the inflation? I will think that the high private consumption has caused the inflation. That's why the Central Bank of Turkey is trying to contain the private sector demand, and they are quite happy with lower consumption demand in Turkey. Yes, if you look from the high inflation effect on consumer demand, I previously say at this program to you that the highest demand is coming from the top income distribution, top 10% or 20% income distribution rank in Turkey, but the lowest income rank, which are the wage salary earners, they do not spend much. So the main reason of inflation is coming from them, and the main reason why the consumption is lowering is also because of the lowest rank. Yes, maybe you can think that the inflation may cause a lower private consumption in Turkey, but let's do not forget as well the high interest rate impact on the private consumption. The saving rate in Turkey is quite low. Historically, the residents in Turkey do not usually save. They tend to consume when they have their wages or salaries, instead of saving to their side, because you have to have a very high interest rate and you have to be very financially conscious to save aside your money. Culturally, previously, historically, we didn't have this tendency in Turkey, but thank God we have this financial consciousness in this country for the last 10 years, and people started to understand the reason, the benefits of saving. And with this high interest rate, you can imagine if you have 50% interest rate rather than 20% interest rate, you will incline to save more. So with this high interest rate, they started to save their money, and domestic savings increased. The domestic deposits in the country increased. This was one of the main targets of the Central Bank of Turkey as well, because they wanted to increase the appeal of the Turkish lira deposits. Yes, they managed to do that. So the savings increased on the Turkish lira deposit side. This is one of the reasons also because of the low consumption. Yes, you may call a 3.3% increase in the private household consumption, 3.3%. Yes, they have revised it a little bit yesterday. Yesterday, they announced the GDP figures with personal consumption figures as well. It's around not 3.3, maybe 3.2% for the first half, but for the third quarter, it's 4.8%, which is okay because we saw quite low domestic demand. Maybe it was temporary increase for the third quarter. I think we will see this low demand to continue for the fourth quarter, despite lower interest rates. So the reason of the relatively low domestic demand in Turkey is not only because of the high inflation, it's mainly because of the high interest rates. Also, the times of near elections, people do not spend more. When there is this economic uncertainty, people do not spend. But normally we have at least two more years to the elections, but people expect an early election in Turkey. So the monetary policy, I think, is very important to contain the private sector demand, household demand in Turkey, I think.
Okay. Taking attention to the neighbors, Şevin, after the Russia-Ukraine war, the euro area inflation reached nearly 10% in 22. But the ECB was very successful in controlling and maintaining the rate below 3%. And they achieved that within a year. Such was the ECB's resolve that the headline number is just around 2.5% now. I would like to understand, Şevin, what drove the Turkey inflation rate so high that it is now so difficult to manage? Just want to understand your perspective on this.
Unconventional monetary policy, you mean for which time?
Basically, I mean, I'm trying to compare the euro area response or the ECB's response as compared to the Turkish Central Bank's response to inflation. When ECB was able to contain inflation within a year from 10% to around 2.5%, the Turkish inflation remained high. And I was trying to associate that with your statement that the unconventional policies were not very successful in managing that.
Okay. Well, first of all, we have to compare the history of European Union inflation, its inflation history, and Turkish inflation history. Totally different, and maybe we can understand there's this past inclination because previously, if you look at the inflation figures in Turkey in 1970s. In 1980s, in 1994, 1994 was a record high. In 2001 financial crisis, we had periodic, of course, we are trying to get rid of it. I agree with that. Since 2002, we are trying to get rid of it. But in 1994, we have this crisis. In 2001, so we had these peak years in 1994 and in 2001. First of all, we have to consider the history of the inflation between these two places, with Turkey and the European Union. The past inflation effect, the past experiences, as an economist, it also affects the current experiences in inflation. You have to consider if there is this uncontrollable effect, it comes from also the past, because people panic. They have already lived in this ultra high inflation periods. Second of all, I mentioned earlier, this is critical element in Turkish inflation of exchange rate pass-through. The exchange rate pass-through effect is quite high in Turkey. It's not as high as in the European Union. Dollar Turkish lira or Euro Turkish lira parity quickly interfere to the prices in Turkey because of the high dependence on the imported intermediary goods. So there was a 20% exchange rate pass-through in the inflation of Turkey. For example, if there is a 1% increase in the exchange rate, like lowering the local currency value, it quickly, in a few months, it quickly affects 120% the inflation in Turkey. So there's this huge FX pass-through, exchange rate pass-through effect in the inflation. Because of the intermediary goods. And also, and this is also related with this exchange rate pass-through, which is also critical and also characteristical for the Turkish economy. The financial instability. Financial stability is quite low in Turkish financial markets, unfortunately, because of the political reasons, domestic political reasons. Sometimes also because of the international relations, also domestic political. And let's do not forget also that the European Union did not use this economic missteps with ultra low monetary policies with high inflation. They did not approach with these irrational policies. Also, there is this huge period of interest rate policy, like playing with a child toy with the interest rates in Turkey for years. You can see from the interest rate figures how they have increased, like 10% increase in a month, 6% decrease in a month. You will see in the history between 2017 and 2020, you will see this child toy play within the interest rate in Turkey, unfortunately. So we have to have this politically confident area in Turkey to contain the exchange rate pass-through to the inflation, I think. These are the main reasons I would call. There are more reasons, but these are the main reasons.
Right.
Yeah.
Talking about the policy rate, Shevin, since you did talk about the rate setting characteristics of the Turkish Central Bank. The TCMB started acting in mid-23 by increasing interest rates from 8.5% in June 23 to 50% in March 24. The interest rate was then held constant at around 50% for almost 8 months, eventually being cut to 40%. Do you think that the Turkish central bank was behind the curve and perhaps acting very late? Also, Shevin, is the monetary transmission very slow in Turkey as inflation remain unsustainable among all channels?
It's a very I would call very good it's a very important way of looking to the inflation and to the interest rate policy in Turkey.
Right.
In March 2024, yes, in March 2024, they have increased it 50%. And you compare it with 8.5%, you said, when it was 8.5%?
Yes.
When was it?
So 8.5% was in June 23. And
June 23. Yeah, right. Yeah.
And it was taken to 50% in March 24. So that was a humongous increase over just a matter of a year.
Yeah. This is the time interval when the new economy team, very respected, credible new economic team, started their job in June 2023, right after the general elections, where President Erdogan had some kind of uncomfortable approach to the election results. Finally, he understood there is something wrong in the economy, and finally he understood that the public at the end wouldn't accept this high inflation, despite they like their leader. So he understood he has to refrain from intervening to the monetary policies, and a credible team has been elected. And I was really keen on and supported the interest rate policies and monetary policy between June 2023. Even in March 2024, for example, when I saw this 50% interest rate hike right before the municipal elections in Turkey, they hiked the interest rate. I was impressed. That time, I started to return to give my commentaries again, because I was having very difficulties for a while to giving commentary, Karan. For a while, I did not give comments to the irrational policy. It was very hard for me. So that time I saw, right before the municipal elections in March 2024, I saw this increase to 50%. I said, okay, something is going very good here. But you are right. Some people agree that the Central Bank of Turkey stay behind the curve by lowering the interest rate and waiting for 8 months with high interest rate until December 2024. Some people thought that the Central Bank of Turkey is behind the curve, and I agree with this. I agree. I also think that the Central Bank of Turkey should start to ease the monetary policy rate in October 2024, right after the Central Bank of the United States, Fed, had lowered its interest rate in September 2024. Maybe in September, October, the Central Bank of Turkey also should start it. Yes, maybe they should have wait 6 months and not 8 months, but it mattered. I think this 2 or 3 months mattered. So nobody understood why they have waited until December. Maybe they have tried to give a signal, a hint to the markets, to the public, that I'm very tight here. I have to be very credible, and people understand that I'm going with this tight monetary policy. I'm very insistent and maybe they thought this will increase their credibility, but at the end it left them behind the curve. I agree with that, because they have to move along with the global central banks. December was a little bit late, so I agree with that. Fed started on September 2024. The Central Bank of Turkey shouldn't have waited for three more months. Yes, you are right again. The monetary transmission mechanism in Turkey became very weak, very slow, and very low. Especially, it is low when the inflation rate is quite high. When it is around 50%, it is lower. But I'm sure when they lower it to 20%, I saw it, I experienced it. In the periods of 20% inflation, we still call it high in Turkey because we target 5%, the transmission mechanism becomes stronger and more rapid. But for the time being, and especially when it was 50%, the transmission mechanism, monetary transmission mechanism was low and weak. And there are lots of reasons for this weakness in the monetary transmission mechanism. First of all, they have played like a child toy with the interest rate, so there's a deterioration in the transmission mechanism. The rationality, the regularity of this mechanism has been disrupted. So it has to be normalized for a while. It will become normalized. On the other side, market reaction is very low right now. You will see in the United States as well, because markets has to be, we had this March 2025 financial turbulence this year. Market needs some assurances that there will be not a political disturbance, political interference to the central bank. Market reaction is very low. Market interest rate reaction is very low to central bank policies when they lower it. And also the inflation expectations, you can check still, the inflation expectations in Turkey is still very high. They are targeting 16%, but the inflation expectations in Turkey is around 50%. And the transmission from, as I said before, about the bank loans for the corporate loans, the transmission from the interest rate loans to bank loans has weakened. The corporate loans is still very, very high, and because the banking sector still has to be very, very careful. Thank you. So this link between the policy rate and the market lending rates, and this link between the policy rate and bank loan rates, a little bit disrupted. It's not as high as the previous time, and transmission mechanism is low because of there are other reasons for low transmission mechanism. Demand also, the private sector demand also, it cools very slowly. The private sector reaction also is quite slow. And I also would say that the monetary transmission mechanism is more keen on exchange rate channel rather than interest rate channel in Turkey. As I said, exchange rate affects many, many sectors in Turkey. Rather than interest rates, exchange rate affects more the Turkish economy. Firms, for example, increases their prices when they see an increase in the exchange rate. They quickly reflect this increase in the exchange rate to their prices. So the exchange rate is much more important. For this, next year is very, very favorable for Turkish economy. So the exchange rate channel is quite high. It's stronger than the interest rate channel. There's high dollarization. Even some of the houses in Turkey are sold in dollar indexed. They index in dollar currency. Many restaurants, many cafes here, many service prices, they index their prices on US dollar. So once the US dollar becomes more valuable than the Turkish lira, it quickly is reflected in the prices. So monetary transmission mechanism through the interest rate channel is also very low because of this exchange rate channel inclination in the Turkish economy. Firms set their prices according to exchange rate movements, expected exchange rate movements. And the exchange rates in Turkey not only affected from the interest rates, but also from other factors as well. Not only because of you will see in March 2025, we have this political turbulence in Turkey. And despite US dollar index low value, the exchange rate increased very, very highly. So there's this FX sensitive behavior in Turkish economy. So that's why the monetary transmission mechanism low right now. But in parentheses, I would say that after 20% of inflation, when they lower it to 20%, it will increase, I'm sure.
Okay. The Turkish Central Bank, Şevin, also sterilized excess liquidity through deposit buying auctions and reverse swaps transactions in late 23. That is December 23 and mid 24. That is August and October 24. Why did the excess supply of deposits flooded the Turkish banking system, Şevin, at the time? And where was it coming from?
Yeah, they had to both increase interest rates and they have to take this excess liquidity from the system. Yes, their job came harder. There are also many reasons. One of the reasons is because they were trying to unwind this FX protected deposits, which we call KKM. It's an invention of the previous economic team, Nebati. His surname was Nebati, Nurettin Nebati, the previous finance minister from Mehmet Şimşek. He brought this, he invented this system, FX protected deposits, and it costed a lot to the fiscal system. So the new economic team decided and considered to get rid of this KKM, this FX protected deposits. Its Turkish name is Kur Korumalı Mevduat, KKM. They have to unwind it. And while unwinding it, some of the liquidity entered to the system. Turkish lira entered to the system because the government interfered, the central bank interfered, just to make the Turkish lira more appealing for the depositors. And while unwinding, some of the excess liquidity entered to the system. For example, and also large volumes of FX protected deposits has been matured. So they have to end all these FX protected deposits by December 2024. After 44 months, they had to end this system. through this unwinding, some liquidity entered to the system. Another one, there was also a fixed fiscal expansion through the elections. One through the municipal elections in March 2024, and previously the government expanded its expenditures. There were the transfer programs, for example, are very costly within the budget. There was also some, there was also unfortunately we had this big earthquake in Turkey, and they have to reconstruct the economy, and there was an earthquake reconstruction spending. It was also a fiscal spending. It was also an inflow to the system. There was also this pension system change, wage and pension payment of the government. So there was also injections from the government side, government cash flow. I will call it election cycle injections to the system. As usual, we have it. There was also, before this new team, there was this FX sales by the Central Bank of Turkey just to keep the exchange rate under control. They sold FX. This was also against public, and many economists have criticized this, because there was an FX sale by the CBRT just to keep the stability of the FX market. It also caused some injection into the system. Central Bank of Turkey gave some Turkish lira to the system at that time. In 2024, let's remember, there was a re-entry of the foreign capital inflows as well. Foreign capital inflows also caused some injection to the liquidity injection, and let's remember, there was a huge government debt redemptions in 2024. So this was another liquidity injection to the system. Those were the reasons for they needed to sterilize this high liquidity in the system, the central bank. So KKM maturities, the FX protected deposit maturities, government spending, foreign exchange interventions by the Central Bank of Turkey, direct interventions to keep the exchange rate volatility, portfolio inflows and domestic debt redemptions, they all caused this liquidity intermarket, and they had to sterilize it at the end.
So in general, Şevin, what is your view pertaining to dealing with excess liquidity through unconventional tools such as sterilization instead of increasing just policy rates?
For the time being, Turkey uses unconventional monetary tools along with the interest rates for a long time, since Erdem-Başçı, since 2012. I'm keen on unconventional monetary policy tools as long as it is rational. I'm not keen on the policy usage of KKM, for example, FX protected deposits. It was an invention and it was irrational, as said by the Minister of Mehmet Şimşek as well. And it created high fiscal cost to the system, and they are still trying to get rid of it. It was a fiscal burden to the system, and also it created a disruption in the economic policy. But as long as it is rational, like sterilization, liquidity. Even Fed uses it, the sterilization of liquidity through the unconventional monetary policies. I am keen on it. Maybe we can talk about the central bank issues later on, if you permit me to talk about it in another episode. Maybe we can talk about the central bank balance sheet issues. But I would support. I'm actually keen on. The policy of sterilization along with the interest rate. These unconventional monetary policies, as long as they are rational, I'm okay with them.
Okay. Finally, Şevin, how has been the Turkish Central Bank's performance in managing the monetary side of the economy? And importantly, what is your critical assessment of its performance since 2018?
2018 is very important. I'm very glad that I can freely and happily give comments for the time being, because it was very, very hard for me to give comments as an economist who had studied at Middle East Technical University with conventional monetary policies, etc. When I saw this irrational policies, I was shocked. Since 2018, lots of things happened, and it was very obvious that we will have this ultra high monetary inflation in 2022. Yes, we saw the deterioration in 2018, but it started with 2017 bad policies in the monetary policy. First of all, let's do not forget that since 2018, we have this 7 years, right? It's 2025. We are in 2025 right now, and they have changed the governor 5 times. In 7 years, we saw 5 governors, 5 central bank governors. However, the normal term of the governor is 4 years. So, and these governors, they haven't taken off from the office. Some of them, for example, Naci Ağbal, he only worked for 4 months. And he has been sacked and he has been taken from the office just because he has increased the interest rates to fight with the high inflation. And we saw very irregular policies. For example, I do not want to remember the time of Şahap Kavcıoğlu as a governor. I was very, very sad when I was seeing his policies, low interest rates. At the beginning, you mentioned about his policies. Thankfully, it coincided with the COVID period, so we did not have this big financial crisis. But the implementations were very, very bad. So I would call unsuccessful, very, very unsuccessful up until 2023. 5 governors, it's affecting the credibility, it's affecting the foreign investors' approach, it's affecting people's approach here, their consumption, everything. So it's important from the credibility side. And let's remember, in 2016, the interest rate in Turkey was 8%, just 8%. And we had single-digit inflation for a long time. Turkey had this investment grade from the international rating agencies. But since then, it was 8% in 2016. In June 2018, you call what happened since 2018, they have increased it 16.5%. Like suddenly they had to increase from 8% to 16.5%. Why so? You can increase it you can increase it slowly and without causing any disruption to the economy. They could have increased it slowly, like from 8 to 9% to 10%. Normally, we should see this, but suddenly we saw in 2 years from 8% to 16.5% interest rate. Why? Because they have tried to stay on this very low interest rate, but but it was impossible to keep low interest rate. That's increasing inflation, and it's with very high financial distress. Oh, we didn't talk about the financial distress in the country as well. Maybe we can talk about it later on. Right. Anyway, because of this financial distress and financial turbulence, they had to increase this interest rate in June 2018. So, yeah, in September, we had 24% at the end, September 2018, with very, he was also credible, Murat Çetinkaya, Governor Murat Çetinkaya. He has tried to increase the interest rate to 24% in September 2018, but he has been taken from office just because the reason of high interest rates in September 2018. And in July 2019, Uysal, another governor, came. As with the high demand of the President Erdogan, he lowered the interest rate to 19%. So, as I said before, they played like a child's toy with the interest rates, and I will never accept these policies. And I was very sad seeing this time period up until mid 2023. As an economist, it was very, very hard for me. Honestly, Karan, I did not give any comment because I didn't want to give any comment. And also, we had very tough times giving freely comment, criticizing here. At least now, thank God, I'm very free to give comments. I can give my comments with rational, with some rationality behind it. So, as an economist, it's an honor for me for the time being to criticize or to give comments. Since June 2020, I'm okay with the monetary policies, and I find the Central Bank of Turkey quite credible, quite successful. Maybe they were a little bit behind curve last year, but they are going quite well. We need now other policies, like fiscal policies, like policies from the government side, like structural reforms, like more political movements, democratic movements in the country, so that this improvements becomes better and better, because it's now the global area is now entering to an easing policy, and Turkey is one of the most important emerging country. So the central bank is quite successful now. The other metrics like government, the fiscal policy, and democratic movements should be taken. But I think it will be okay afterwards.
Very insightful discussion, Şevin. Well, on that note, that's all I have for today. We will meet again in season 2 to discuss the Turkish Central Bank's evolving balance sheet and the way forward. But thank you once again for the time, Şevin, and being part of the show.
Thank you. It was my pleasure. And maybe we can talk about the financial situation of the country as well at your next episode. I will be pleased to join again. Thank you.
Thank you very much, Şevin.